everyone, this is Dr. T. Varalakshmi and I'm going to be discussing you about the ratio analysis related problems under the part of business economics and financial analysis. Already that I have discussed with you the formulas and maximum the theory part under this BAFA classes in the previous videos, liquidity ratios, activity ratios, profitability ratios, capital structure ratios or solvency ratios, what are their prescribed formulas and what is the standard ratios of that one, their usages, advantages, disadvantages, some of the limitations and the applications part, all that elements we have discussed. And now in this class that I am going to be discussing with you the problems related to the ratio analysis. In this one, once if we see this problem related to this one, the following is the balance sheet of the company as on 31st March, and generally this is the after getting the final accounts of the any business organization, that analysis or the applying the mathematical expression on the elements of that final accounts is called as the ratio analysis. Here in this one, they have provided the balance sheet informations, which is consisting of the share capital, profit and loss account information, general reserves, 12% debentures, sundry creditors, and bills payables, etc. information. Whereas on the assets side, land and building, plant and machinery, stock, sundry debtors, bills receivables, cash at banks, that information they have provided. And from these informations, they are asking us to calculate current ratio, quick ratio, inventory to working capital ratio, debt to equity ratio, proprietary ratio, capital gearing ratio, and current assets to fixed assets ratio. It is very easy, that one, the ratio analysis, if we have the knowledge of the differences between the current assets and the current liabilities. So from this total assets up to the land and building, plant and machinery, this will be called as fixed assets, whereas the remaining stock, sundry debtors, bills receivables and cash at bank will be called as current assets. And in this one, up to the debentures, it is called as the fixed liabilities, and the remaining two will be called as current liabilities. Now, current ratio is a combination of current assets to current liabilities. So, current assets, total of these these four elements divided by the total of two elements will be called as the current liabilities. Current ratio, current assets divided by current liabilities. And quick assets divided by the current liability, except the stock, the remaining will be called as the quick assets, because the stock is not will be accumulated to the next year and it won't be sells or accumulates to this particular year. So that's why, except the stock, the remaining will be called as the quick assets. And very quick assets will be bills receivables and cash at bank and cash at hand. That is an acid test we'll use. So anyhow, accumulation of these three, that is quick assets, and these two current liabilities will be called as the quick ratio. And inventory to working capital ratio. Inventory means stock and working capital means current assets minus current liabilities. So we know this one, current assets total minus current liabilities. Then we can calculate this inventory to working capital ratio. That is inventory divided by working capital 1. Debt to equity ratio. So in this fixed liability position, the amount in the form of debenture is called as the debt position. The remaining amount will be called in the form of equity. This proportionate of these two, this one is called as debt to equity ratio. And proprietors ratio indicates out of the total assets, what is the equity shareholders part can be calculated with the help of proprietaries ratio. And same as the capital gearing ratio. So out of this share capital, what is the profit levels earned by them? And current assets to current fixed assets. This is the fixed current assets and the above two is the fixed assets. The ratio between these two will be called as this current assets to fixed assets ratio. All these are all the matter of adding and subtractions and the divisions are only, but we must have the knowledge of what is the ratio analysis, and we must have the identification of current assets, current liabilities, fixed liabilities, debt capital, equity capital. If this knowledge we have, then easily we can do this ratio analysis. So the solutions, if we see current assets divided by the current liabilities. So in this one, the current assets are of a total stock 2 plus 1, 3 lakhs 50,000, and current liabilities of 1 lakh 50,000. So that is 3 lakh 50,000 divided by 1 lakh 50,000, 2.33 is to 1. The strongest part of the organization, because it is having more than 2 times of the current assets for their current liabilities. That means the organization has more liquidity with them, and the standard, more than the standard ratio the organization is maintaining, and they are ready to spend the money for their further operational activities. And the quick ratios, liquidity assets divided by the liquidity liabilities. So here in the given problem, except the stock of 2 lakhs, the remaining will be called as the liquidity assets, that is 1 lakh 50,000 divided by this 1 lakh 50,000 liquidity liabilities, so that it is giving the total of 1:1. That is a standard ratio. It is meted, so that the equivalent worth of the current liquidity assets are all there for the liquidity liabilities. So organization is in a good position and a standard position to meet its liquidity activities. And third one is inventory to working capital. So inventory means the stock worth of the 2 lakhs, and working capital means current assets minus current liabilities, whereas the current assets 3 lakh 50,000 and the current liabilities of 1 lakh 50,000, that is 2 lakhs worth of the working capital is there, 2 lakhs worth of the inventory is there, 1:1. So whatever the working capital is there, with that working capital sufficient inventory they are going to be purchasing. And debt to equity ratio. So long-term debts divided by the shareholders' funds. So here if we see, the long-term debts are all called as the debenture 4 lakhs 20,000, and whereas the equity shareholders' worth is 2 lakhs 70,000, that is 2 lakhs 30 plus 40, 2 lakhs 70,000. That is calculated here 1.5:1. So which means the organization has more debt, nearly 1.56 rupees of debt, whereas the equity for 1 rupee. So which means ownership capital is 1 rupee, means they had got the debt of nearly 2 rupees for that one. That is not suggestible for the organization. They have to pay more interest to that one. Or we can use the another formula also for this one, long-term debts divided by shareholders funds plus long-term debts. So here is also we can long-term debt 4 lakhs 20,000 plus total long-term capital, that is 0.6:1. So which means if the capital of the organization is 100, means 60% of the amount is belongs to the debt holders. So that is its meaning. And the fifth one, proprietary ratio. If we take the shareholders funds out of the total assets, we have to calculate. So that is, proprietor means the owners. The ownership capital, that is the equity capital, is 2 lakh 70,000, and the total assets value is 8 lakhs 40,000, and that has calculated here 2 lakh 70,000 divided by the 8 lakhs 40,000, that is 0.32:1. So which means maximum 60% of the funds belongs to the debt holders, means out of the total assets only 30% of the 30% of the assets belongs to the proprietors. So that is the one. And capital gearing ratio, that is interest bearing securities divided by equity share capital. So that is not the organization's profits or everything. So only equity, preference and debt only takes into the consideration. Equity, that is dividend bearing, interest bearing securities are all called as debentures. Here the debentures 4 lakhs 20,000, equity shareholders of 2 lakhs. So that is only they have taken into consideration 4 lakhs 20,000 divided by 2 lakhs. So that means more than 100%. That is 2 times more debt capital is having by that company than the ownership. The next thing is current assets to the fixed assets. Current assets out of the Out of this 8,40,000, if the current assets are all 3,50,000, the remaining 1,40,000 plus 3,50,000, 4,90,000 is belongs to the fixed assets. That ratio is we have calculated here. Current assets to the fixed assets, 3,50,000 divided by 4.9 lakhs, that is 0.7 is to 1. So that shows that the organization is having 70% out of the two parts. Fixed assets is more than the current assets, and current assets are all 70% of the total fixed assets. So that is the ratio between the fixed assets to the current assets. Like this, from the given data, we can calculate the various ratios. Same as this one, from the following particulars, find out the trading profit and loss accounts provided trading profit and loss account of a company. Work out the operational ratios of the business concerned. Operational ratios means gross profit ratio, net profit ratio, working capital ratio. These are all the ratios will be called as operating ratios. Now, they have furnished the details of the trading account as well as the profit and loss account. So here opening stock, purchases, direct expenses, gross profit information, net sales, closing stock, that information they have provided, and the operational expenses of administrative and selling distribution and financial expenses, net profits, and gross profits information under all they have provided for us. Now, operating ratios, before going to operating ratios, formula is cost of goods sold and other expenses divided by net sales into 100. Now, we are going to see how to calculate the cost of the goods they have sold. So, first of all, they have the opening stock of 14,000. With the purchases, they have added 6,400, and direct expenses incurred is 3,000. For this one, if we less this closing stock of 6,000 rupees, 600 rupees of worth of the closing stock, then we will get the 7,500 rupees worth of the cost of goods sold. For this one, if the other expenses like indirect expenses, administrative charges, selling and distribution, that is provided in the profit and loss account, and the financial expenses of 100 rupees, if we add, that is 2,000 rupees worth of that, if we add, then they will be called as operating expenses. Operating expenses. Now, the calculation of the operating ratio is both direct and indirect charges of that goods, means direct expenses of 7,500 plus indirect expenses of 2,000 out of the net sales, total net sales of the organizations they have provided here under the trading account. This 10,000 value, if we have taken into 100, means 95% of the amount they are spending for the operations. The remaining 5% is the profit per the organization, which means if 100 rupees they are getting as a revenue, 95% of the 100 rupees, that is 95 rupees, they are spending for their operations, and the remaining 5 rupees is the profit for the organization. So like this, we can calculate the operating ratio from the given problems. The third problem is, the following is the summarized profit and loss account of Taj Products Limited for the year ended 31st December. So here they have provided, included up to this one, direct expenses and manufacturing expenses. Up to this one, it is a trading account. The remaining is called as the profit and loss account, but combinedly they have provided the information of opening stock, sales, closing stock, stock of the finished goods, that is a closing stock, stock of the material, non-operating incomes, profit and that one. From this one, they are asking us to calculate gross profit ratio, net profit ratio, operating ratio, and cost of the ratios to the production, that is materials consumed ratio, labor cost ratio, production overheads cost ratio. All this one they are asking us to calculate. For all this one, gross profit ratio means gross profit divided by net sales is the formula. Net sales into 100 is the formula, and already they were not provided the gross profit, but net sales they have provided. For this one, we have to calculate the gross profit. So how to calculate that one means, first we will calculate the operating cost of the goods sold. For that one, from that one, net profits if we less this net profits value, that is the net profit of 1,50,000, then the remaining profits will be called as the gross profits. So like that we can calculate the first gross profit and cost of the goods sold. Then after doing that working notes, we can start doing of the calculation of these profitability ratios. So let us see this working notes related to this one. So gross sales of the given problem is 8,50,000. So that is 8,50,000. Out of this one, first we need to less the cost of goods sold, that is opening stock of the material plus materials which they have purchased, 3,25,000, total 4,19,500. So with that one, stock of closing stock, if we less 89,000 rupees, then we will get we will get this materials consumed, that is 3,30,000. Out of this one, 3,30,500 rupees. So for this one, direct wages and the manufacturing expenses, direct wages as well as the manufacturing expenses, if we have added, we got the cost of production. Cost of the production of 5,70,000. For this one, we have, if we less this closing stock of the finished goods worth of 60,000, then we got the cost of goods sold by the organization, 5,10,000. If we want the gross profit, we have to less this administrative expenses and the selling distribution expenses of that one. Then we'll get the net operating profit before interest and taxation. If we add net profit, income, interest and profit on shares, so this is the amount we got profit on the sale of the shares and loss on sale of the assets, if we less and financial charges, then we'll got the income before the taxation worth of 1,50,000. So from this one, working notes, we'll start this one. Gross profit ratio is equals to gross profit divided by net sales into 100. So the calculated gross profit worth is 3,40,000 here. 3,40,000, whereas the net sales of 8,50,000. So this is the net sales or the gross sales. We can take net sales 8,50,000. Then we have calculated the gross profit ratio is 40%. Out of this one, net profit, already in the problem they have provided 1,50,000. For that one, net profits, for that one we have to add the other expenditures. 1,50,000 of the net profits divided net profits plus profit on sale of this assets is here it is 1,50,000 only. 1,50,000 net profit divided by 8,50,000, that is 18.82%. And operating ratio, cost of the goods sold plus operating expenses divided by net sales into 100. So here in this one, cost of the goods sold value 5,70,000. 5,70,000. Sorry, not this one. Here it is cost of the production, it is 5,70,000 plus other administrative expenses of 1,80,000. 1,80,000 divided by the net sales of 8,50,000. 81.18% of the amount they are going to be spending for their operational activities. And fourth one, material consumed ratio, that is materials consumed divided by cost of the products. So here the materials consumed is 3 lakhs. Materials consumed value we have calculated is 3,30,500 divided by cost of the productions, that is 5,70,000, that is 57.98% of the material they have consumed. And next thing is the second problem, they have asked us to calculate labor cost ratio. Here the labor expenses are all they were not provided the labor expenses, but we can take this direct wages information, that is 2,25,250. And second thing, if we want to calculate, that is 2,25,250 divided by 5,70,000 rupees into 100. We can take this one. And third thing, production overheads ratio, production overheads divided by cost of the production into 100. And whereas the productional overheads ratio, there we have calculated 14,250 rupees. Here it is the productional overhead 14,250 rupees divided by the cost of the production of 5,70,000. If we take that into the consideration, 2.5% of these productional overheads they are using for this productional activities. So like this, we can calculate these profitability ratios from the given profit and loss account. And the fourth problem, if we see, from the following balance sheet and the additional information, you are required to calculate return on the total assets, return on the capital employed, return on the shareholders' funds. They have provided the balance sheet, that is a share capital of 8 lakhs, each share value of 100 rupees with the reserves of 2 lakhs, 8% interest payable debentures of the 2 lakhs, creditors of 1,60,000, fixed assets of 10 lakhs, current assets of 3,60,000. And net profit before the taxation is 2,80,000. Assume the tax rate is 50% and the dividend declared amount is 1,20,000. With this information, we need to prepare the return on total resources, that is profits after tax divided by total assets into 100. So profits after taxations, they have already, profits before taxation is 2,80,000. 50% tax means 1,40,000. If it goes for this taxation, remaining 1,40,000 is called as the profits after taxation. So that profit after taxations divided by the total assets worth of 13,60,000 they have taken into the consideration, and 10.29% is calculated for the return on total resources. So out of their assets, they are getting 10% benefit from that one. And return on capital employed, profit before interest and tax divided by capital employed. That is the capital they have taken. Profit before taxations, that is 2,80,000. So 2,18,000 plus they have to add the interest rate of 16,000, 8% of the debentures for this one, 8% on debentures worth is 2 lakhs. And 8% interest rate is 8 twos are 16,000 rupees. Of that interest, if we add, then it will be called as profit before taxation and interest also. For that, 2,80,000 of the profits before taxation plus interest of 16,000. If we add, then it will become 2,96,000. And capital employed worth is 8 lakhs of shares one, and debentures is 2 lakhs 10, and the reserves already received for them is called as 12 lakhs. So out of this 12 lakhs, they got a profit of 2,96,000, means 24.7% of the profits they have gained. And return on shareholders funds is profit after taxation divided by equity shareholders funds. We need to take profits after taxations is 1,40,000 worth, and shareholders funds, out of this one, the equity shareholders is 8,000 plus, and their reserves of 2 lakhs, 8 lakhs plus 2 lakhs, that is 10 lakhs only we have to take into the consideration. And that is 10 lakhs, that is 14% of the benefit gained for the equity shareholders funds. Like this, we can calculate the ratios for the given problems. The simple one next thing, if you see this one, a company has a capital of 10 lakhs, its turnover is 3 times the capital and the margin on sales is 6%. What is the return on investment? So they have provided the ratios and they are asking us to calculate the remaining element. Capital turnover ratio, we know sales divided by the capital. So capital turnover ratio 3 times they are saying means turnover ratio they have given. Sales we need to calculate for the capital of 10 lakhs. Then sales is equals to 30 lakhs. Then rate of the return on investment is gross profit divided by investments into 100, and the gross profit of the organization is 1,80,000 divided by 10 lakhs. So this gross profit is calculated of 6% on 6% on 30 lakhs. Sales 30 lakhs into 30 lakhs into 6%, that is 6 divided by 100, that will be gives the gross profit 1,80,000 divided by 10 lakhs of the capital investments into 100, that is 18%. Whereas the gross profit is calculated by using this formula. So like this, we can calculate the return on investment. First, we came to know the sales, and from that one, we came to know the gross profit, and we have calculated the return on the investment. Like this, with the given data, we can calculate the various ratios and information, and we can interpret about the financial strength of the organization easily. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.